Thank you to everyone for joining us this afternoon. I'm delighted to welcome Jim Henderson to speak to us this afternoon, where he's joining us today from Utah, where it is 7 o'clock in the morning his time, and he's surrounded by snow. So, Jim, thank you for joining us first thing in your morning there. Aristotle Capital Management have managed the North American fund for St. James's Place clients for over a decade and have been highly successful in that time, despite various market and economic issues that have occurred over that period. Jim is here to talk about his fund, the market, anything else that comes up during this Q&A, as I'm sure there'll be some questions on some topical events as well. The structure of today's event will be as interactive as I can possibly make it. And although I have had questions submitted by attendees in advance, so thank you for those, please put your questions in the Q&A box as we go as well. My aim here is that we get through as many questions as we possibly can, as many market themes as we can, and that the session is shaped by you, the audience, and what you want to be discussed. So I will put as much as possible to Jim on your behalf. So to start the conversation off, Jim, and to give people a chance to submit questions if they want to, let's start with a nice, easy one. Can you introduce your strategy that you manage our US fund with, and how you manage money as a firm within Aristotle?
Well, great. Thank you. And Darren, thank you for having me today. And I appreciate everyone's time who's dialing in today. It's much appreciated. Just a brief introduction to Aristotle Capital Management. We are an independent registered investment advisory firm based primarily in Los Angeles, although we have offices in Newport Beach and in Sarasota, Florida, and Boston, but it's primarily based in Los Angeles. For St. James's Place, we manage a U.S. or North American equity portfolio with a value style, a value tilt to it. The way that we manage money and the way that we identify particular businesses that we would like to invest in is start by looking for companies that we believe have a clear competitive advantage. We call it quality, so it's quality value. And these companies that we're investing in, we believe, are doing something unique. They're different, whether they're market leaders or niche players, that they have a business plan and a management team that is superior to those within their industry. Once we've walked through that door of identifying that quality business, if you will, and we believe that there's only about 300 of those that are based in the U.S. and maybe another 300 of those that are based internationally. Once we've identified those businesses, the second part of our process is then the valuation phase. Can we afford to buy this business? Is it trading in the marketplace at a substantial discount to our appraisal of their business value? And we could spend the rest of the hour talking about how we go about doing that. But suffice it to say, it's very similar to the way that a private equity firm would value a business if they were going to buy the entire company. So we're valuing that business based on what we believe their intrinsic business value is. And then the third part of it is to identify factors within that business that we believe are not well understood in the marketplace. We call those investment catalysts. And what I would like to leave you with is that, they're more like differentiated thought process. So what do we see in the company that's not well understood in the marketplace that is going to turn a great company into a great investment? Not every great company is a great investment. There are some great businesses that have been in business for a long time. They're gushing free cash flow. They're doing great things, but they never seem to have any reason to buy them, and their stock can languish for years. So we want to identify those investment catalysts that we think are going to take this business from point A to point B. So that's kind of in a nutshell what we're doing in the portfolio.
So we will drill down into the fund over time. As you can imagine, a lot of the questions we got in advance were about bigger themes and everything else going on in the world. The world is full of noise, as I always say. But I've spoken to you several times in recent years, and you've always said to me how different to anything else this situation since 2020 has been. as we speak in December 2022, how do things feel right now?
Different. It is different. I mean, you're right. We have had these conversations, over the past couple of years, and I've always said that, and I still believe that. We've never gone through a set of economic issues that we've been faced with that have been driven by factors that we've not seen, that I've not seen in my lifetime. I've never been through a pandemic. I've never been through economic lockdowns where economies were artificially closed down for extended periods of time, where businesses were asked to close their doors and for various reasons, lay off employees, where we've seen unemployment rates get to significantly high levels. And that's caused things to be very different when we started coming out of that situation and started in our economic recoveries. One of the things that I'm always asked about is the inflationary environment that we're in now, and interest rates are continuing to go up. And are we going to be faced with an economic recession because of that? And there was a great article in the Financial Times just a week or so ago that talked about, and this is under the theme of why it's different. During the economic lockdown, the excess savings rate in the U.S. skyrocketed. And there's a number of reasons for that, right? As we're all sitting in our homes and we're not going out to dinner and we're not traveling, and everyone who managed to maintain their employment started to increase their savings rate because there's really nothing to do with your money. And then if you combine that with all of the economic stimulus that was handed out by the U.S. government, and not just the U.S. government, the U.K. government did the same thing, as did the rest of Europe, handed out, billions, hundreds of billions, and trillions of dollars. The savings rate in the U.S., the excess savings rate was $2.3 trillion. So think about that. The excess savings rate in the U.S. was $2.3 trillion. So now, as the economic lockdowns abated and people were back out spending their money, this excess savings rate, boom, we have inflation, right? So the question is, how long does that last, and what are the ramifications of that as it applies to maybe a recessionary environment? And what the Financial Times said is that we've worked that 2.3 trillion down to about $1 trillion. So we've still got $1 trillion to go. So if you're going to guess when an economic recession was going to happen, and by the way, in the history of my career, I have never seen an economic recession so widely anticipated as one is now. And that typically means it's not going to happen. But it's certainly not going to happen until that extra $1 trillion in savings is worked down. And we're starting to see that a little bit now, although the job numbers that came out just the other day were stronger than anticipated. So it hasn't happened yet. So I expect inflation to be with us for some time, and that widely anticipated recession that everyone's talking about is probably not going to happen until maybe later in 2023 or maybe 2024.
I was going to go on to interest rate next, but I'm going to skip and go straight to inflation because you brought that up, and it's a good link. Right. Is inflation something that's a concern to you in your decision making? I think it's easy to talk about the big macroeconomic themes and actually right. What does that actually mean for the investor when you're actually picking companies? Yeah. So when you're actually looking at companies, where does inflation come into that decision making, or is it something that you've just always taken into account? Because let's be fair, inflation isn't anything new. It's happened before, it happened again. So where does it come into that?
Yeah, I mean, it's always been taken into account, but you can't divorce inflation with interest rates because they're very interconnected. If you go back post-financial crisis, so 2009 onward, when we were going through that valuation process that I talked about and employing many of the techniques that a private equity investor would employ, there are many factors that go into that. Interest rates and inflation expectations are part of that. At that point in time, we were under an extended period of zero interest rates. Our process works on the theory of normalization. What is a business going to look like when it's operating normally? And that process of operating normally is not just specific to the business, but it's also the environment that a company will be operating in. And a zero interest environment is not normal. So when we were going through that process of analyzing the business and valuing it, we never suggested that they were going to continue to operate in a zero interest rate environment. More normal is, say, a 3 to 4% 10-year treasury yield, that if you're going to use any type of an interest rate in a valuation process, that was more normal. So we had already been baking that into our valuation process. Secondarily, now to get to the inflation part of it, generally speaking, and there's always exceptions to things that I say, but generally speaking, the companies that we are investing in, because of that quality aspect that I talked about, because of that competitive advantage that these companies have, tend to fare better during an inflationary environment than those that are maybe also rans within an industry. So if you have that competitive advantage that your products or services are differentiated from your competitors, you generally have the ability to pass your increased costs along more seamlessly than does maybe a weaker constituent within an industry. So the companies that we tend to invest in not only can do well during an inflationary environment, they actually thrive. They are able to increase their market shares. They're able to acquire maybe some weaker constituents within an industry. I think Parker Hannifin, which is one of the companies that we own, is a great example of that. They've been very acquisitive over the years in bringing in businesses in fragmented industries that they can apply their management techniques to and be very successful. And I'm often asked, well, with increased interest rates, can they continue to do that? Do they have the financial wherewithal to continue to be acquisitive? And the answer to that question is yes, they do. They have a pristine balance sheet. But the other part of it is when there is an opportunity to acquire another business, the competition for that business is much less now because there aren't very many players out there that do have the ability, the financial ability to acquire those businesses. So for the most part, companies are going to continue to do well during an inflationary environment.
Yeah. For those watching, Parker Hannifin is 2.7% of the current fund to the data I've got here. So it's in the top 10 holdings. So it's a significant holding that Jim's talking about there. We'll discuss various other holdings because I've got some questions on a few of those, Jim. But it seems to me that certainly it feels that a lot of the volatility that's being caused, and that everyone will know there's a difference between risk and volatility, but a lot of the volatility being caused this year has been as a result of the market ignoring what the Federal Reserve is telling you they're going to do. That sometimes feels that markets are therefore reacting to the smallest hints and the smallest phrases, or if there's a word here or a word there.
Correct.
Do you think that's starting to shift, or is that going to move into 2023 as well? Because it feels to me like, well, maybe it's just been a 6-week period where things have just settled down a bit, but you've had some pretty large swings over the last 6 months where, let's be fair, the Federal Reserve have just done what they said they were going to do in the first place. So where do you stand on that?
Well, I think volatility is going to continue, and the volatility, you're right, is driven by the news of the day. And this just as recently as yesterday, we saw the market sell off, quite a bit. And it really is a risk-on, risk-off attitude, right? As the news is coming out, and it looks like maybe the Federal Reserve's at the apex of the interest rate advances, and that things are going to quiet down from here, and the market's going up. And then you had the news, as I mentioned, that the employment numbers were well ahead of what expectations were. I think expectations by economists were around 200,000 on a monthly basis. It was 266,000. So then the market sells off because employment is still strong. That means the Fed's going to continue to increase interest rates. We don't spend a lot of time in our firm worrying about that kind of short-term noise that is affecting the market from a day-to-day basis. We're looking more at secular trends in businesses that we think are going to affect them over a 3 and 5 year period. As I said, we value businesses based on our appraisal of their normal business value. And, as 2009 and 2010 was not a normal period, we're actually more in a normal period, although inflation is higher than is normal. And we would expect to see the Federal Reserve continue to increase interest rates to get that under control. If I can, I'll tell you a brief story of, I remember when I was a young economics student, back in the late 70s. Yes, I am that old. And I was at the University of California at Los Angeles, and we had the head of the Federal Reserve, his name is Arthur Burns, come in and speak to our class. And if you remember, or if you've read about, back in 1979, inflation was running rampant. Interest rates were at all-time highs. We had energy shortages and a period of time not dissimilar to what we have today. And I remember Arthur Burns coming in and saying, we can argue about how we got here and, don't want to get political and start blaming this or that. But, there's a lot of reasons why you get into an inflationary environment. But it's very simple how you get out. This is not brain surgery. You have to contract demand. You have to increase interest rates. You have to contract the money supply. And there are some ramifications to that. Generally, you're going to increase unemployment and you're going to contract economic activity. But that's what you have to do. This is not brain surgery. And the Federal Reserve, as you said, has been quite open about what they're going to do. Now, I would argue they were a little late to the party in starting that and getting that done. But we see no letting up of that anytime soon. We're only at about a 3.5% yield on the 10-year Treasury. That's probably going to have to go up, and at some point that's going to cause the inflation numbers to not look the employment numbers to not look as robust as they are today. And we expect to see an economic decline, as I said, as soon as we work off that $1 trillion of excess savings that are in banks right now. And, that's how you do it. But Arthur Burns did say this. He said it's very difficult to do because when politicians do that, they tend to get themselves unelected, right? Because it's not a popular thing to do. So they didn't do it. Then there was an election in 1980, and there was a change in the head of the Federal Reserve. Paul Volcker came in and did exactly what was needed to be done. And then from 1980 to 1982, you had difficult times. But after 1982, in the U.S., we had an economic expansion that was unparalleled in the history of the country. So, we're going to go through some difficult times, but we should come out the other end, being very strong and seeing, robust economic expansion. So if your time horizon is more than 2 years, then it should be okay.
And I think that's the key for long-term investors. I think,
right.
Everyone on this call will have a different idea of what their time horizon is and their objective is, et cetera, et cetera. But from an investment point of view, there is no one size fits all here. It's if your time horizon is long enough, history would suggest that there is, remaining invested is probably the best thing to do. I did have a smile to myself there where you started talking about politics, because I do try and sway away from politics, and I'm not just,
here it comes.
I'm fighting not to chip in with the people vote with their pockets comments and things like that, but they do, and it's
they
true.
Do.
It's not just the US; it's going to happen everywhere over the
right.
coming years. But we're not going to go quite there yet. That's for next year's webinar, Jim, if that's right. I'll get it booked in afterwards. So bearing in mind that the majority of the audience will be UK based, I think we get a lot of questions on the Bank of England and things like that. It's the Federal Reserve essentially. If what they are doing works, is that then the template for what everyone else ends up doing in the UK and Europe and elsewhere around the world?
Well, the short answer is yes, but it's not just the leadership of the Federal Reserve that's showing that. It is an economic reality, okay, for everybody. I mean, if you're faced with, and I know the UK's inflation rate has been even a bit higher than ours, and I will apologize as an American because a lot of the inflation that we've experienced, we export. So we've exported some of that to you. I mean, the dollar is
and we
the
thank
reserve
you for
currency.
that.
Yeah. I don't know. I appreciate that.
11.2%. We're enjoying it. Yeah.
I will apologize again profusely that we do export that inflation to you, and obviously oil is denominated in dollars, and so when you have increase in energy costs, and that's going to cause us to export some inflation to you. So I apologize to everyone, and that's the case. But with that said, the Bank of England hasn't helped either, and the spending of the UK government hasn't helped either. So those are issues that have exacerbated inflation again, and we can talk about the reasons why we have inflation and why interest rates are increasing. But the solution to the problem, as I said, is not brain surgery. It's what has to be done. It's going to have to be done in the UK as it will in other parts of the world that are experiencing the same issues as we are in the US. I do think the Fed was a little slow to the party, but they've caught up. And, I expect to see the Fed increase interest rates over the next, couple of sessions by 75 basis points each time. And at some point, that's going to slow the economy down, and we'll get, back to normal.
Okay. So we've covered the economy. We've briefly covered politics. Let's drill down into the funds and the returns and performance and things like that. So the US market is down. The Nasdaq's heavily down. The Nasdaq was flavor of the month for a long time, flavor of the decade maybe. The S&P then took over, and that's been driven downwards by a number of things, which we'll cover off, I'm sure. But in terms of your fund, what are the key winners that have caused you to hold up better than the market and maybe other funds? And also, are you surprised at how resilient some of these companies have been? So there's sort of two prongs to that question. What companies have done well? And is this what you were expecting to happen?
Well, as I mentioned, the basic philosophy of the firm is to identify higher quality businesses that have a competitive advantage. So many of them have maintained that advantage throughout this economic downturn, and as inflation has risen, have been able to pass their costs along. I think one of the companies that I think has surprised, for their resiliency has been a company called Martin Marietta. Martin Marietta, for those who are not familiar with it, their business is taking big rocks and making smaller rocks out of them. So they make aggregates that go into construction and cement, and just about everything that is manufactured requires aggregates to do. So they take big rocks and make smaller rocks out of them. Their resiliency has been in pricing. So although their volumes for their products have been very strong, and they do also make cement. So the cement and the aggregates make concrete, right? Now, cement is highly dependent upon two main inputs, and that is labor and natural gas. And we've seen labor costs and natural gas prices increase. But Marietta has been able to pass those costs along. Early on, when inflation first hit, they were a little slow to do that, but they've caught up. So not only has pricing been strong for them, their volumes have continued to increase. So their profit margins have actually increased during this period of time. So they've been very resilient. Another company that comes to mind is a regional bank called Cullen Frost. Cullen Frost is based in Texas. And if I had to put my finger on the company in the portfolio that benefited the most from higher interest rates, it would be them. They are a traditional, no-nonsense bank. They take in reserves and they lend them out and they earn the spread. And as interest rates have risen, their net interest margins have actually exploded during that period of time. So they've done very, very well. Disappointments, I can't really think of one that hasn't acted. Obviously, not everyone in the portfolio is doing well. And, one of the major headwinds that we've had in the portfolio is our lack of energy exposure. And that's not an accident. That's by design. Back to our original philosophy, we tend to avoid companies that are competing solely on price. And for better or for worse, most energy companies are competing solely on price. And, in the last year or so, that price of the commodity in which they're dealing in has been very successful. So most energy companies have done very well, and we haven't owned them. So that's been a major headwind for us. The other headwind, and these are companies that we've owned for a number of years, has been in the technology area. We've owned Microsoft and Adobe and Ansys and Qualcomm for quite some time. And if I look at attribution for our returns over the last 3, 5, and 7 years, those companies have been major contributors to our outperformance versus the general benchmarks. Not so in the last 12 months, as we've seen interest rates rise and inflation rise. The prevailing level, without getting too technical, but the prevailing level of market multiples, so let's use PE as an example, price to earnings, is directly and inversely related to the prevailing level of interest rates. So as interest rates rise, the general PE of the market decline. So those companies that have market multiples or even greater than market multiples tend to suffer more when you have a PE contraction in the market. And that's what we saw in the first quarter. Interest rates and inflation first started to get, really meaningful at the end of last year and then in the first quarter of this year. And those companies, again, nothing fundamental has changed with them. So we continue to own them and we continue to believe that they have bright futures. But, they're facing some headwinds in the short run because of that.
And in any conversation about a US fund, it is and global funds, really, it's absolutely impossible not to mention technology. Yeah, these are companies we've never seen the sizes of before. They run our lives, et cetera, et cetera. We won't get into that. But can you talk to us about two stocks that are in your top 10 holdings? So Microsoft is one and Adobe is the other one, that have been, I think it's fair to say, very successful stocks within your fund.
Right.
But can you talk to us about why you've held those over recent times and what your current thoughts are on those? And then I assume we'll get onto the other ones that people see in the headlines all the time.
Sure. So as I mentioned earlier, we don't spend a lot of time or intellectual capital in trying to forecast short-term macroeconomic events. We may spend, a couple of hours a year thinking about interest rates and things like that. Those are factors that we believe are out of our control. And again, back to my theory of normalization, we're normalizing things anyway. So what's going to happen in the short run is not something that we spend a lot of time worrying about. What we do spend a lot of time understanding are secular trends in not only the economy, but in sectors and in industries, factors that we think are going to be economic disruptors over a long period of time. And we spend a lot of time understanding those secular trends and those economic disruptors. One of the things that we identified, I think, early on, and this is talking about Adobe and Microsoft, is the transition that enterprise software companies were making into cloud-based enterprise software offerings. So historically, the way that companies operated, software businesses operated, was you got a disk, and even prior to that disk, if you're old enough, you remember the floppy disks and those drives that you put in to buy their software, and you had copies of their software, and then when a new version of that software came out, you got another disk. You paid for it, right? And you upgraded that, and things progressed along and progressed along. Well, what's happened over the last couple of years is they don't do that anymore. They've moved all of their software offerings into the cloud. And that's created a couple of major benefits for these companies. Their expenses, their marketing expenses are significantly lower than they've been in the past, because now they don't have to have this big marketing base convincing you that you need to buy the next floppy because it's got all of this new stuff that you need. That is done in the cloud overnight, and it's just seamless for them. Secondarily, instead of buying a software license, you're now buying a subscription that you pay for monthly. There's two things that has been a major benefit for these software companies. Without the source code of their products now being in the public domain, they're in the cloud. That lessens the possibilities of piracy. So people were taking these discs and they were copying them for their friends. And the companies, they did everything they could to encrypt them. But, the piracy people are smarter than the software companies, and they're able to break that pretty easily. One of the statistics that I had read when we first started looking at Adobe was that for every 4 users of Photoshop, so we all know Photoshop, it's one of their big offerings. For every 4 users of Photoshop, 1 was paying for it. So they were getting 25% of the revenues that were due them. Now, as they've transitioned into this cloud-based subscription model, that's gone away. So now you've got this whole big shadow user base that now is becoming a paying user for their product. Been a game changer for them. Been a game changer for Microsoft. So, Microsoft Office is now Office 365. It's cloud-based. They bring new products to market cloud-based. It's been a game changer in the enterprise software business. So that's something that I think we identified very early on. And it's been very successful for us, not with just those two, but with Ansys and a couple other companies that we own in our international portfolio. So then the question is, all right, that's known. It's been around for a while. Where do you go from here? Well, in the case of Adobe, yes, their cloud-based software offerings like Photoshop and others, that's primarily been completed, but there's other aspects of their business that they're in the early stages of releasing in cloud-based. They're in the very early stages of monetizing Adobe Acrobat. Acrobat is something we all use. Most of us don't pay for it. The only people who are paying for it right now are those that are creating documents for distribution. So they pay. They're in the process of monetizing that. So we still feel like there's a great deal of opportunity in those businesses, and we continue to hold on to them.
And I talk all the time about the market not being the economy. I mean, we spent a lot of time at the start talking about the economy, but it feels like the market, none more so in the US, where the market really isn't the economy. How much of a potential issue is it for investors that the current concentration of technology stocks mean a quarter of the market could be 6 companies, etc.? I mean, so for context, while you were answering that question, I've had Facebook, Netflix, and Tesla mentioned in questions, which just shows that these things are in the public eye. They are there. I'm not going to ask you your individual views on individual companies or even the heads of those companies, unless you want to go there. But
sure,
that feels a risk for investors, that you are genuinely drawn to things you feel you know about, which means that you're missing opportunities elsewhere at the expense of these big things that will either drive your wealth or crash it.
Yeah. So, I mean, the popularity of the FANG stocks, right, from really, post-financial crisis through probably mid last year, if you looked at the concentration of the S&P 500 that was invested in FANG stocks, the number was staggering and unsustainable, right? It's just, it kind of reminded me of 2000 when, the dot-com era was, that that prevalent. And although I was not alive at the time, I have read many stories about, back in, 1910 and the early 19 teens when technology like radio was first invented. And anything that had to do with radio had these huge multiples. And, we went through the roaring 20s, and then the depression hit in the 30s, and all of those companies went broke, except for a couple. RCA, the Radio Company of America, survived, and the same thing happened in 2000. A lot of the companies that were the dot-com favorites, they're no longer with us, but there were some that survived. And some of those companies, those FANG companies, are successful for very good reason. Okay, Apple is a great company that commands much higher profit margins for their products than do their competitors. And one has to ask themselves, why is that the case? Why is an Apple iPhone carry a much higher profit margin than does a Google phone or a Samsung phone? Why is that? Well, it's because Apple has done a great job creating an entire environment that people enjoy, and so they are able to maintain that higher profit margin. That is not sustainable. I mean, over some period of time, Economics 101 will tell us that that is not sustainable, that they will kind of fade back to normalcy over some period of time. They've done an awfully good job of protecting that monopoly, and who knows, they could protect it for a number of years. Netflix is another example. That's one where we have actively said that's a terrible investment based on the pricing that it was at, because the only way that a company like Netflix is able to not only survive but thrive is if they spend billions of dollars in content. If they don't have billions of dollars spent in content that people want to see, there are other opportunities. And just look at the most recent competitive environment for Netflix with, all of the pluses like Disney Plus and ESPN Plus, and CNN tried Plus, but that didn't work out so well. But there are others that are there that are continuing to be competition for Netflix, and it's going to be difficult for them. And obviously their share price has recognized that.
And so a question we've had a couple of times actually during this session. Given the volatility of the market this year, you mentioned a couple of things there that have been hard hit. Has this given you the opportunity to reposition the fund to take advantage of things in the market that maybe became new opportunities, or even top up things that you thought were cheap anyway and are even cheaper now? Are you able to talk to us about what might have changed in the fund over the last sort of 11 months or so? New names that have disappeared, etc.
Sure. We have what we call kind of our pencil list. We'll call it a farm team of companies that we've done our work on. We've gone through the vetting process. We like the businesses. So they're kind of on our list, right? These are companies that we'd like to own given the right circumstances. There have been a couple of companies that we have sold recently that's given us the circumstance or the ability then to bring them into the portfolio. We now own 2 regulated utilities in the portfolio. We haven't owned a regulated utility in the portfolio for years and years and years. Generally they're tough businesses because the regulators tell them how much money they can earn, right? So their returns on equities are not of their own doing. They are of whatever it is the regulators suggest that they can be. Now, we sold a couple of companies. We sold Walgreens, which you and I have talked about in the past. I think we were very patient with that company. It had underperformed both from a fundamental standpoint and from a stock standpoint for some period of time. They went through a management change. We finally went through our review discipline and decided to sell that. And we replaced that with Atmos Energy. Atmos Energy is a natural gas distribution company based in Texas. They have an opportunity to bring to market a very advantaged feedstock, because one of the areas of the world that has the most plentiful supply of natural gas is the Permian oil basin in West Texas. They have hundreds of years of natural gas in the Permian Oil Basin in West Texas. So Atmos Energy is able to take that advantage feedstock and distribute it throughout both residential and industrial users in the state of Texas. We also all know that the state of Texas is growing and growing significantly. We've seen businesses move there. Elon Musk moved Tesla there. Toyota moved their U.S. headquarters there. Charles Schwab moved their headquarters there from San Francisco. TD Ameriprise has got a huge office there. So Texas is growing significantly. So we look at an opportunity to see a business that both their end markets are growing. They have an advantaged feedstock, so we've added that into the portfolio. We also added an electric utility company called Excel. And as I mentioned, the regulators are the ones who are setting the pricing and setting their returns on equities. But what they've allowed with Excel is a greater return on renewable energies. And Excel has led the pack in renewable energy. So wind and solar has been a significant increase in electric power generation for them, and they're able to earn a higher return on that. So both of those companies have very high dividend yields, like 3.5% to 4% right now. But we believe those companies can increase those dividends by high single digits, low double digits every year for the foreseeable future. So 5 years from now, we're going to look back at those investments and look at what our cost basis were and say, gosh, we're earning 20 to 25% a year on our cost basis because they've been able to increase their dividends.
So for the last section of this, I usually have to try and wrap up. So we've gone in themes so far. I usually have to try and wrap up all the questions that we'll be getting. So this may feel a bit scattergun from this point, but I want to get through as many as we can. Let's start this section of it, which is usually a bit more random. What's your portfolio turnover been this year? Has it been higher than usual?
No.
Good answer. So for those
who give you short answers now.
Portfolio turnover is the amount of the portfolio that's changed this year, whether it's been bought, sold, et cetera, et cetera. So, Jim is essentially suggesting there that this year's volatility hasn't really seen a change in strategy, which is, strangely enough, the answer that I wanted him to give, and he succeeded in that. So let's speak. Right. So this one we had a couple of times, both before and during. Has the recent issues within crypto affected your thinking at all?
No.
I knew you'd say no on that. I mean, it's obviously in the news, and it's obviously
sure.
I'm assuming it's in the news in the US because it's everywhere here.
Oh, yeah.
What's the actual impact, actual potential impact of all this? Why is the media going really hard on this?
Well, because there's a lot of people who've lost billions of dollars, right? And anytime that happens, it's going to make the news, and particularly when you have a relatively bombastic young man who might be behind a lot of those billions being lost, then that is clickbait for social media and the news, and then you add in all of the celebrities and such that were investing in that, and it's going to make a lot of news. But from our standpoint, we're not invested in that, nor would we ever. So then the question that you have to look at is there any, second or third iterations of this crisis that could affect the businesses that we own? And the answer to that question is no.
Yep. Okay. Somebody's pointed out here, the fund has a relatively low exposure to real estate. Could there be hidden risks here linked to real estate, as in the global financial crisis, within the financials that you own?
Well, we have three. Now we have two. So we own a company called Sun Community and Equity Lifestyle Partners, and both of them were real estate investment trusts. Both of them were in manufactured housing and RV parks. So nothing very esoteric. They're not in real estate or in other aspects that might be a bit more volatile. These are great businesses, and as the aging of the population continues in the States, having alternative sources of housing for retirees is a good thing. We bought both of those. They're both very similar in nature, although they are different in geography, so they tend to focus in different areas of the states. When we bought the two of them, we bought half positions in both because we liked them both, and they're both very similar. And then as time went on, I don't want to say it was a horse race, but it was kind of a horse race. We were looking at both to see which one was going to be more successful in our eyes going forward. And Equity Lifestyle Partners kind of won the horse race. And so we sold Sun Communities, and we took the kind of half position in that and reinvested that into Equity Lifestyle Partners. So we took a full position in that. The other kind of real estate related business that we own is a company called Crown Castle. And Crown Castle owns cellular towers. So they build and own the cellular towers, and then they lease them out to the cell phone companies. In the old days, when cellular phone business first started, the cellular companies owned the towers. It's not the case anymore. Companies like Crown Castle own those towers, then they lease them out. And they can lease them out multiple times for a single tower. So you've got 2 or 3 or sometimes 4 companies using those same towers. So as Crown Castle increases the user load of their towers, from right now it's a little over 2 to a little over 3, as they should over the next 3 to 5 years, all of that money drops to the bottom line. Secondarily, what Crown Castle has done that others have not is they've invested a lot of time and money in what they call these mini towers. So a cellular tower, we're all familiar with those. They're these big behemoth things that we see on the side of the road. They're ugly, and sometimes they try to dress them up, make them look like trees, but they're still big cellular towers. What Crown Castle's doing is creating these mini towers in congested areas, so large cities. And they're just little devices that sit on the top of a street lamp. And that street lamp device then, through the optic cabling that they have, can reduce the traffic in the cell towers by taking that and then moving that along to the cell towers. They have literally 100,000 of those mini towers and 83 million miles of optic cable that's going to reduce the traffic that you see in large cities. Why is that important? Because 5G takes up a lot more bandwidth than did 4G and 3G, and this is very much needed. So that's really the real estate exposure that we have.
That's good. So that's covered that sector. Another sector that's been asked about is biotech. Do you have much in the biotech area?
Well, we we have Amgen, which is one of the largest biotech companies in the world. They've been very successful, have a number of new products that have come out. One Repatha, which is a product that lowers cholesterol in those that don't accept a statin well. I mean, a lot of us that are over 50 have seen our cholesterol numbers rise, and most people over the age of 50 are now taking statins to reduce that. It works for most people, but for a lot of people it doesn't. And so Repatha is a product that has been very successful in reducing cholesterol rates for those that are not responding well to a statin. The other new company that we added to the portfolio is Merck. Merck is an old kind of healthcare business that's been around for a long time. They just spun off a company called Organon, which is a women's healthcare franchise that was a significant part of the business, but it was a low margin part of their business. So they're going to get about a $9 billion free cash flow dividend for that spinoff that allows them to focus more on their branded pharmaceutical products like Keytruda. I don't know if you've seen the ads for Keytruda, but Keytruda's been successful in over 30 different cancer types. They have nearly 80 studies now, phase 3 studies that are evaluating the benefit in 20 additional cancer types. So it's really been a game changer for them. They have a number of other new products that are on the horizon. They've come out with a new vaccine that has been very successful in pneumococcal. This pneumococcal vaccine that is indicated for those over age 60, been very successful. So yeah, we have invested in several companies that we think, as the population ages, will be very successful.
That's good. This one sounds a bit a basic question, but I would have my own way of answering this, but I'm going to ask it for you anyway to see how you.
Well, no, I'm going to let you answer it then.
Well, that's fine. That's fine. But it may. I think people have come to listen to you rather than me. Is it a good time to invest, Jim?
Well, I will hearken back to what Sir John Templeton said many years ago, and he always said, the best time to invest is when you have the money. Now, I cannot sit here and tell you what I think the market is going to do over the next 6 months or over the next year. But if your time horizon is 3 to 5 years, particularly 5 or more, I can with a pretty high degree of certainty tell you that you're going to do well. So it all depends on your time horizon. So if it is 5 years or more, yes, now is a very good time to invest.
I'm now wondering how many caveats we're going to have to put on the recording of this to make sure. Jim, I think time's got ahead of us. I'm afraid I have a lot more questions, but I'm going to have to wrap this up. Thank you so much for your candid answers. Indeed, thank you to everyone who sent their questions in, both ahead of the event and during the event as well. We will go through the questions afterwards and answer what we can and come back to you individually where we can. Jim, thank you so much. It's great. I always enjoy interviewing you. And I'm always going to get honest answers, and that's usually all that an interviewer can ask. To the audience, we will be looking to do a lot more of these more often next year. So please keep an eye out for these from your SJP partner. Please stay safe, stay well, and we will see you again, hopefully. Thank you.
Thank you all.